Hello, guys. I have the real deal of ton, Mary Ballard, with me today. I'm so happy to have you on the video podcast. Thank you so much for being with me today.
Thank you for inviting me.
Absolutely. We've been
As
talking
always.
about this, forever, and finally it's becoming a reality. And I know you're so knowledgeable when it comes to money and mortgages, and I want a lot of the people to see you and meet you personally through this podcasting.
Okay, great.
So why don't you tell me a little bit about yourself? I know you very well, and we
Yes.
have done many deals together.
Yep.
And I know Brad; he's an amazing mind. He's a great
Yep.
salesperson and very knowledgeable. And just tell me a little bit about yourself and the company, and how long you've been living in town, and all that stuff.
Sure. Mary Ballard. I'm with GoldStar Mortgage. I'm the operations manager over on 33rd Street here in North Beach Restaurants and Shops. Been there since the end of 2009. Been with GoldStar Mortgage since 2010, the beginning. So I've been with GoldStar about 13 years. Been doing lending in South Florida for 23 years.
Wow, that's a long time.
Been in this neighborhood. We live in Bermuda Riviera. We've been there for 21 years. So I guess you could say I'm a lifer.
The trigger point that let you get into the mortgage business.
Oh, that's a long story.
Yeah.
That's
That's
a long
we have time.
story. I used to be a nurse way back
Oh
when.
wow!
Brad was in title. And
He was doing like title insurance,
title
or he
work,
was
title,
title
he was
work.
title agent. So he would be the closer.
Very cool.
Hence the reason why he's such a good closer.
What really triggered? Like you were obviously
It's
you
just
become a
it's
nurse.
more of a transition with life, so to speak. 'Cause
Yeah.
My son with Bradford, man-child was born, and he had started a mortgage company on the side, and I was looking to do something maybe a little bit different from nursing, and I just
And maybe it was easier to take care of the kids. You
yeah.
had your own
I had my
hours.
schedule. Like we had a partner, and so I was able to just work a few days a week, or
So when you guys first started doing mortgages, was that your own company, or you
it
started
was.
with
So we
GoldStar?
owned your best interest mortgage for 10 years.
So I know the difference, but I want the audience to understand the difference. Like when you say that I own a mortgage company, right? Are you actually lending your own money for
Not
people
when
to
you're
purchase?
a mortgage broker. So
Okay.
when you're a mortgage broker, you take the loan in and then you go find a lender to fund it, to close it with.
Okay, so you basically the middle guy trying to find the best deal for the potential
Right.
client to get the best rate, best terms, such and such, right?
So
And you don't.
then, it was the crash. We made it through the crash. I think I made it through because I learned how to do conventional loans, Fannie and Freddie.
So you're talking about the 2008
Eight
crash. So did you see that coming? That crash? How did it go?
We saw things getting,
How
there
was
was
it?
a lot of things that kind of spurred it. First in South Florida, it was those hurricanes that were back to back and like 4, 5, 6. And then the market, the banks started failing. You started losing your subprime lenders in 7 and 8. And then it just became, you couldn't really, all the subprime lenders, Washington Mutual, Fremont, Long Beach, like they all just went under. And the heyday was over. So I think I happened to get lucky, and I was taught how to run the loans through a system, Fannie and Freddie, and I just learned how to.
Main opinion about the 2008 crash was because it wasn't really heavily regulated, and a lot of
But there was
there's no
regulation.
regulations.
There was no
Wow.
regulation. I used to have account reps for the second lenders come into my office, and I used to have, what do we have, 6, 7, 8 mortgage brokers, processors, assistants. And the account reps would come in and be like, you're stupid if you're not doing a second mortgage behind every single purchase transaction
Wow.
up to 125%. You're just leaving money on the table.
Wow.
I'm like, that's 125% loan to value. I'm like, what if the values start, settling down? So it was crazy. It was the wild, wild west. And if all you did was subprime, then that's why you failed.
So what do you see this current market? Because a lot of people are nervous, and a lot of people are talking about this
Completely
next
different.
crash is coming.
It's completely different.
Yeah.
The main thing is everything is fully verified. We all know, that.
I mean, you did
You
my
know that.
personal mortgage. Talk about why do you think that 2008 crash is a little bit different than what we are going through today? Because I hear from a lot of people, especially the real estate clients, and they're talking about an upcoming possible crash. So how do you compare two markets to each other?
Well, first of all, we're not crashing.
I know.
We're not crashing.
Especially South Florida. In South
Go
Florida,
try to get under contract with a financing offer.
Correct.
We're not crashing. So the main things are, for the past decade, 12 years, 13 years, 14 years, everything has been full income, full W-2s, paychecks, bank statements, everything. We even verify your social. We make sure your social is right.
So what you are saying is that from 2008 crash, the regulators and the federal government
In
and people who are
2010,
actually lending the money,
the CFPB changed everything. So
correct?
that Dodd-Frank Act changed everything in 2010.
So all these, regulators, they got together and they said, let's not make this
They
happen again.
right, they created what's deemed qualified mortgages. So everything really has to be for a qualified mortgage. It's a conventional Fannie Mae, Freddie Mac, FHA, VA, USDA, or jumbo. Those are qualified mortgages. So here's the main thing. So right now, everything for the past 14 years has been full documentation, right?
Okay.
On all your qualified mortgages. Now, along the way, we've created non-QM mortgages, non-qualified, but we still need bank statements or a
When you mean
1099.
non-QM, can you explain that what it is?
Non-qualified. So in 2010, the CFP created the rule, the Dodd-Frank, and you had to have, certain things for a qualified mortgage. So all of those fit under the umbrella: Fannie Mae, Freddie Mac, FHA, VA, USDA, jumbo. They all fit under the qualified mortgage umbrella. So you have to provide your income, W-2s, tax returns, or paychecks. Minimum is a W-2 and paycheck,
Okay.
not necessarily paychecks and tax returns. If you're self-employed, minimum is 1 year self-employed. So a non-qualified mortgage, which we've seen come about in the last few years, are people that are self-employed, but they can do bank statements because they don't necessarily write they write things off on their tax returns.
So you are saying that there are still a lot of options for people that they don't have an ordinary
more
job with
options,
W-2s and all of that
right,
stuff.
right.
Like, for example, myself, I'm an entrepreneur. I have many businesses.
Bank statements.
And sometimes, putting my taxes together and then just, doing all of that stuff can be time consuming with extensions and such. But you are saying that there's other alternative lenders today that are called under the umbrella non-QM, non-qualifying, and you can still pull those,
Bank statements,
bank statements,
1099,
1099s.
non-income verified investment properties.
Tell me a little bit about that.
So if you're an investor, you can now go buy a home. You don't have to show me any income for yourself, but the property that you're buying has to fully income qualify.
So when you say that the property has to income qualify,
So the rent has to cover a percentage ratio of the mortgage payment.
so I hear this from a lot of the people that, they come up to me and they say to me, I want to be able to buy an investment property. And do they still have to put certain amount
Down, 20% minimum, ideally 20 to 30.
Okay. And
Ideally 680 credit score or above.
and then how much of that income, potential income from that investment property has to cover the mortgage?
It can 100% of it.
Okay.
You can go down to like maybe a negative 80% of a lender.
Yeah.
So if we're circling back to why I don't think we're headed for the crash of 2008, first, banks are completely regulated now,
Okay.
especially your larger banks.
Okay.
They're regulated. Everything we do as far as getting a mortgage is regulated, whether it's QM or non-QM. We do have certain things we have to show. So back then, the banks were going under, the lenders were going under, the programs completely dissipated. Nobody was showing their income. Nobody was really ratioing their income. And most of these borrowers were in subprime loans with crazy margins, right? They may have been fixed at 7%, and then their margin would be 7%. So then they would wake up and then they would be at 14%. Now, even if you get an ARM product, your margin is somewhere between 1.75 and 4 at the most.
Okay.
Your margins are much more palatable. You don't, on all your qualified mortgages, you do not have prepayment penalties. So that's one reason why I don't think we're going to crash, because we've been doing fully income verified, whether it's property or individual or the business. We've been doing something to guarantee to qualify this mortgage, this property.
So
this
what you're
borrower.
saying is that you are doing all the homework up front, making
Yes.
sure that the person who's applying for the specific
Yes.
lending product has
Yes.
got all the
And
qualifications.
there's all these background reports being run on properties, on borrowers, on other names, other socials. Like there's all kinds of reports that are being ran in the background.
And I remember that, I don't want to cut you up, that, during 2008 crash, a lot of the bad loans, they were stacked up and they were
the good
sold as
loans.
securities. But
Right.
today,
Because they would take those credit score borrowers that were
Correct.
non-income and they would package them with the A-paper loans.
correct. But today, all those stacked up loans, even they are being sold as securities on the market, they are all good loans because you have the full qualification on those loans.
Right. The other reason that, not to cut you off, but the other reason why I don't think that we're not going to crash is people have equity.
Correct.
We have equity.
I know the property prices have gone up.
We
like,
have
yeah.
equity. Why would you go into foreclosure if you have equity?
100%. And especially just looking back, you've been living in here over 20 years and you raise your kids in this neighborhood. And I have this conversation with a lot of people all the time who are looking to purchase a property in South Florida, especially in Fort Lauderdale area. I love Fort Lauderdale because we have the new runway that is attracting a lot of foreigners coming to our new city.
Yep.
And if you look at downtown area, it's been booming. And especially where we live, Bermuda Riviera, Gold Ocean Mile, Dolphin Isles, just east of Coral Ridge, the Barrier Island, I find it a magical island. And you've been living
It's
on the island as well.
every
And
month.
yes, it is appreciating everyone. I want everybody to hear
Yeah,
this.
it's
You
appreciating
purchase
every month.
a piece of land, piece of earth, piece of dirt, whatever you call it, on the east side of Upper Fort Lauderdale, it will double or triple in value within 10 to 15 years.
Yeah.
My consensus, by looking at the numbers, it seems like every 7 to 10 years, property value seems to double. How do you feel about condos and single-family homes and going up in valuation?
Well, so again, back to my reasoning of why we're not crashing. You know, when you see the indexes for appreciation and home sales, they're all based on what you're looking at, what you hear about on the news, what you think is current and relevant for this month. It's based upon the past year. What's happened over the past
It's already
year.
has been.
Right.
It's
So
been and
even-
has been news that
even-
we are
right.
just hearing from it.
NBC and CBS, they all like to, the housing reports are down, appreciation is down. So if you
Correct.
look at one housing report, it'll say, like CoreLogic housing report, it is looking at what sold high and what sold low and becoming an average.
Correct.
You know, there's other more exact housing reports that you need to look at that show you truly
You could go
what's
by the-
happened over the last year.
Correct.
And if you think of three things, income, we've all fully verified. That's A. B, we have equity. C, COVID, everybody's like, well, everybody went into forbearance. Everybody didn't make payments for 12 or 18 months. What the forbearance was in 2020 was nothing compared to what happened from 2008 to 12. Once they went into forbearance back then, we as a lender had to make sure that they had made that payment for 12 on-time payments before they could get a new mortgage, whether it was a new purchase or a refinance. When COVID happened and everybody went into forbearance, it was a very clear-cut, simple method. They tacked on all that interest onto the back of the loan, so they just increased the payoff. Then what they said was, if you wanted to sell your property after making no payments for 18 months, you can sell, and the very next month, I can give you a mortgage. If you
Wow.
want to do a
So that freed up-
refinance, I just tack on that to your payoff, and after 3 months of new mortgage payments, I can refinance you. So
Well,
all those borrowers are not getting in trouble. If they come out of forbearance and they can't make their payments, they have equity.
correct. And
to
people
sell.
people have to understand that, the lenders are there to lend the money. If they cannot lend the money, they're not going to make any money.
Right.
So they're not going to let the market crash on its own. They're going
Right.
to do everything in their power in order to protect all the clients that they
Right.
have been servicing for years. But, there's a lot of different products. A lot of people are very knowledgeable about 30-year fixed mortgages. So your mortgage is, fixated on that current interest rate for 30 years. So, and then there's adjustable rate mortgages. They have
Not
fine
so very popular.
Yes, 5-arm and 7-arm. And I want people to understand, because there is this big word on the street. There's like, I'm not buying anything at 7% interest. I'm just going to wait for the interest rates to come down. And my consensus on that is that, yes, the interest rates are today is high because we are riding the wave, but they're going to come down. But what interest rates being high is going to cause the property values and the prices to come down, and you should take advantage of that. Because, I've heard that once from a good colleague of mine. She said that you should date the interest rates and marry the property. And Mary, what do you think about that?
Yeah.
So you think, is this a great time to buy?
Yes.
Or
I think buyers you have more bargaining power. Because even though we are still appreciating, we may have softened a little bit, but that just means we've gone from a double-digit appreciation to maybe single-digit. So, there's a lot more buyers in our marketplace now,
Okay.
right? If you look at the 3304 Oakland Park zip code, there's a lot more millennial buyers in the marketplace,
Correct.
right? There's 12,000 more buyers than there were a couple of years ago because there's more millennials. We've only built we've only have new construction at like 3,000.
Correct. And
So our property, our buyer to property ratio keeps getting smaller because we're not really able to build anymore where we are in this beautiful island.
correct.
Where are you going to build?
And the property values, it's going to cause the property
Right.
values to go
And
up eventually.
the buyers are only increasing from the foreign buyers to the millennials, more millennials in the market. In 2008, when we crashed, we had like 9 million less people in the country. Who was in the market buying in 2008? Me, the
Yeah.
Gen Xer.
Correct.
There was
Now
like-
you purchase your property, you're living in
Right,
it, maybe
I'm
it's
good.
paid
But
off or not.
now, if we're going to be in that crash, there's more millennials in the marketplace than there were Gen Xers.
Correct.
A lot of that's
But
because
how do you feel about these millennials? You know, the new
They're in the
generation.
market.
They're in the market
to buy.
But there are a lot of them. They're talking about just renting, and they have a different mindset. They want to freely roam, you know, around the country and live in different places
and
because.
keep paying your landlord's mortgage.
Correct. And
Like
I believe in that, just like you said,
Yeah.
that it is time to buy a place. You are graduated from college and you have a great job and you hold on to that job for 2 years. Go ahead and buy something. I feel that way because interest rates are meaningless. You still need a place to live. If the interest rates are high, you're most likely the rent payments are going to be high because the money is costing higher at the buy rate to your landlord as well. So keep that in mind. So coming back to the different loans, that 30-year fixed and the adjustable arm. So a lot of people heard the term of adjustable arm mortgages and it sounds scary. Oh my God. You know, I heard this guy got a great mortgage. He was only paying $900. But once the interest rate raised, now his mortgage is like $4,000. He's losing his home, all of his savings, all the money he has put down. What is the back end of that story?
Well, that's probably when you had 1, 2, and 3 year arms.
Okay.
Now the arms that you have are 5, 7. They're much safer. And like I said before, the margins are much smaller.
So when you say that 5 to 7 years, what is that 5-year
You're
arm?
fixed for 5 years. So whatever rate you close at, you're fixed for 5 years. And then you go into that rate or that whatever that index, that arm index is tied to, plus the margin that lender gives.
Plus, you don't have the prepayment penalty.
No.
So if you choose to sell the property in 2 years from now, you would be able to offload it, right? Plus, if the market has corrected itself, the interest rates are back down, you would be able to refinance it at a lower rate.
Exactly.
So basically, there is no penalty of purchasing a place
While
today.
you're waiting for the rates to go down, that property is still going up. If I have a buyer, so I had a millennial buyer in a couple of weeks ago, and I showed her over a 5-year period, if your rent is $2,100 and your mortgage payment is $2,180, you're paying that landlord $160-something thousand in rent over 5 years. Guess what you gained in principal? You paid yourself $25,000 in principal, and you've gained $100,000 in equity in 5 years. So you want to pay your landlord $160,000, or do you want to pay yourself $160,000?
Yeah, building equity is the number
Right.
one thing. You know, I read a lot about it. Like back in the days, Americans, people who lived in the United States, looked at purchasing their first home as a part of their retirement.
And
you know,
we forget that too.
Yeah,
don't
a
we?
lot of people
we just
forget
think of
that.
it as a place over our head, right? So we can sleep and be safe and feel comfort. But it is an avenue for retirement.
I mean-
I have a perfect example, and not to cut you off.
Go ahead, go ahead.
So perfect example of that. So one is a buyer I bought 3 years ago. I gave him an equity line last year of $150,000. He took that equity line and now he bought a investment property through us, GoldStar Mortgage, and now he's Airbnb in that property.
Oh, wow.
So he's already investing towards his retirement, which his only goal was to get a family for his house. But then as I started talking to him, I'm like, you got all this equity. Why don't you use it to buy an investment property? So he's growing his retirement portfolio.
Yeah, instead of just letting that money sit there,
Make
it's
your equity work for you. Right?
100%. I love
You
that.
got $50,000 in credit card debt. You're paying 20-something%, 18%. It's not a tax write-off.
100%. I love that. I
Do
might
an
be looking
equity
into that
line.
now. Now you're digging into
Do
my
an
mind. Now
equity
I'm
line.
looking at like another property
Pay
for sure.
off that debt and make, your mortgage interest is always a tax write-off. But the most important thing, just to finish, come full circle, I'm doing a reverse mortgage for a gentleman presented to me, 79 years old. He had $80,000 left on his mortgage, but his payment was $1,900 because of the new insurance requirement. His payment was going to go to $2,700. He makes $3,300 a month in pension and social. You would think that would be a nice retirement life, right?
Yeah.
No, he was left with $200 a month spending money to eat. to eat and pay electric.
I know the cost of
So
living has.
now on his reverse mortgage, he's going to get access to 400,000 ish. He's going to pay off that mortgage of 70 grand. I'm going to give him 140 at closing. He's going to have another credit line after 12 months, about 180 that he has access to. Game changer. He no longer has a mortgage payment. He's going to have 140 grand in the bank. He can get a home health aid, and now he can enjoy
What a
his
fantastic
retirement.
product. What a fantastic product. So how do you, for people who might be listening to this, like how do you qualify for a reverse mortgage? You have to hit a certain
You have
age.
to be 62.
Okay.
But, HUD has come in and changed all of that. So it's calculations. You put in how old somebody is, the property, the value, and it tells you exactly what they will give.
Oh, wow.
Some people may or may not qualify. I think the younger you are, much more stringent.
So people who qualify for the reverse mortgage get to live in the, specific
Yep.
property
they
until
still have
they.
to make basic income to pay their taxes and insurance and a residual income of their electric.
But
and
other
stuff.
than their, the basic necessities, the utilities, taxes, and insurance, they don't make any other payments, and they get to live in the property
Yep.
until they die.
Yep.
Wow, that's a great
Yep.
product for me. I have
So-
no kids.
So again,
Most likely after this
why
age,
you want
I'm
to
not
invest in real estate for your portfolio, for your future, for your possible retirement.
100%. Building just collapsed.
Miami, yeah.
Miami, that's right. Was it Hollywood?
Surfside.
Miami, Surfside. And since that happened, the condo market has
Game changer.
game changer. I remember you and I were just discussing that you have this
Changed
questionnaire that you send it to condominiums, and a lot of the lenders added like 9 to 10 more questions.
Wasn't the lenders? It was Fannie Mae.
It was the Fannie Mae directly from the
Fannie Mae,
government.
yep.
Okay, so tell us a little bit about that, because it's been a
Been ever changing since it came about last February.
yes.
So last February, Fannie says, guess what? We're going to add on to our full review condo questionnaire, and we're going to give you 3 pages of structural inspection questions. You need to answer those if you want to be able to finance a condo at 95, 97, 80%.
Okay.
Throughout the year of 22, things kind of kept changing. If I went a limited review condo, which I would do most times because most condos didn't carry their reserves in their budget, I did a limited review and I didn't have to do that structural inspection.
Okay.
Well, come November, December of 22, a few months back, it changed again. Now limited review has to have the structural. Come January, okay, if the structural says we failed our thing, we're okay, we know what work we need to do and we've assessed it, and this is the dollar amount, we could close like that. Well, changed again. Now, if you have any type of structural work going on, all the work must be complete before you can close in that building on a conventional loan.
So what you're saying that I know numerous buildings in Gold Ocean Mile, like
So restoration, concrete restoration is different from failing your structural inspection,
okay.
right?
So
I, Mary Ballard, Mortgage Mary here on the Galt, know a good amount of the condos that you can close in. There's ones that I'm still trying to get, resolved, but
it
there's
is-
a couple that you cannot close.
So what you're talking about, that 40-year inspection, a lot of the folks didn't realize it, that most of the buildings, not most of the buildings, all the buildings in Miami-Dade County and Broward County, and I don't know, the Monroe County.
Some waived the right to have it, and they just opted for the 50-year.
But they never got inspected for the first 40 years. The first inspection, major structural inspection,
years.
was on the 40th year. And from the 40th year on, these buildings are supposed to get inspected every 10 years or so, right?
Mm-hmm.
So you're telling me that at the 40th year, the building would have the right to waive that inspection?
I think if you were certain stories, now I don't know all of those condo laws.
Okay.
I am now becoming more adverse in those because I'm in condo world here. But I believe if you're under certain stories, you could waive that. But even though, for so long, the state of Florida has said, just an example, condos, you don't need to carry the reserves in your budget. We don't care what you do. We trust you to know how you're going to take care of your buildings.
And May
Pretty much.
26, 2022, the Senate passed a new bill.
Right.
And
so by the end of this year, everybody has to have reserves.
2024, December 21st.
These condos that were $200 and $300 a month, they're not going to be that way anymore.
Yeah. So I'm looking at some projections because I live in a condominium and we have only 10 units. You're very familiar
Yep.
with it. You financed it. And we didn't have much. reserves. Now we are going to be doing a reserve study. This reserve study, which all the condominiums and associations are going to be mandated and obligated to do, that is going to discover what needs to be replaced
Shortfalls, yeah.
and what needs to be maintained, and whatever the replacement duration or the time. For example, like we are in 2023, if the roof has to be replaced in 2033, and the replacement cost based on the economics is going to be $1 million, they're going to force each association to have $100,000 a year for the next 10 years in order to cover the replacement of that roof. That's what it is, right? So I write these weekly articles, I blast them out, and it was one of the most important things I think I wrote this year, the first quarter. How do you think this is going to impact? I think, my opinion, firstly, I think it's a great first step to have all the condominiums and buildings to get into a very healthy condition with great reserves. But at the same time, it's going to be like a tidal wave hitting the condo market, because most of the people who retire have a fixed income, and I don't know if this is going to be.
It's going to affect it.
It's going to affect it, and it's going to cause a lot of special assessments. Like in my building, we are talking about $27,000 to $30,000
What
a
if you
unit.
don't have $30,000?
Then what happens?
And then you hit and you get then they divide it out over whatever, and now your payment doubles. You're on Social Security at $1,600 a month. What are you going to do?
100%. This is my concern. I love the idea, and I wish that the state would just jump in and they would start a product saying that, for the first time, people who are going to be affected by this bill should get some type of loan or grant or something from the state, and maybe the payments can be embedded to the property taxes can be write off from the federal taxes, like they had it for the hurricane impact windows and the roof replacement for some of the cities and counties when it was mandated. Because I don't know how a person is going to be able to. I mean, just looking at our quarterly payments,
are going to go up.
100%. Our quarterly payments are $2,200. They're thinking about raising it just to keep up with the reserves after a special assessment, $4,000.
Yeah. Now still is the time for buyers to buy. There's certain things you can look at in the condo. If we can get that structural inspection done and we know everything and assessments have been made, it's a great time to buy. Especially in the condos, you can get in for 3 or 5% down, millennials.
Yeah, let's do it. Did you guys hear it? Stop. Just to give that notice, 60-day notice to your landlord, and come and see Oscar as your real estate broker and see Mortgage Mirror. We make a great team, and we have closed many deals together. Yeah. That's great. So a lot of the people are not aware of closing costs. Right now, the market has been changing. Right, there is no such a competing market for buyers. It's a more relaxed situation. You don't have to waive the inspections, the appraisals, and the loan terms. You don't have to close it in 10 or 15 days. It seems like it's a more relaxed environment. So, what do you suggest the closing costs? I know that you mentioned
I say between 3 and 4%.
3 and 4% of the, and then, but you mentioned that there is some the types of negotiations that we can put it on the table now in this current market with the seller's part.
So let's say you're a little nervous of the 7% interest rate or 6.5%, wherever we're at today. The sellers, instead of if you're a listing agent, instead of dropping your purchase price because you're not getting the hits that you want on the property, but the value is there, don't drop that list price. Offer a seller concession, 1 to 2% of purchase price, and give that to the buyer as a rate buy down. So it's not an ARM, it's an introductory rate for the first 1 or 2 years based upon the percentage given by the seller. Let's say the seller gives you a 2-point seller concession. So we would use that, you would have that fee that's charged you for the rate buy down, and then you would have a 4.5% rate for the first 12 months, 5.5% for the second 12 months, introductory rate, not an ARM. Then you would turn into your regularly amortized product.
So what I am understanding from this, just to make it clear, that the seller's concession actually ends up paying the difference from between the introductory rate and the actual rate that was quoted.
Yep.
Right? And plus that seller's concession, because it pays the difference in interest, can be write off from your taxes.
Yeah. And then if you refinance in a year, whatever that credit was from the seller, if we don't use it, if it's not all utilized, if you come back to GoldStar for the refi, then we can use it as a credit towards the refinance.
Wow. How about this? Like a lot of the people have been talking about this online. Then I don't know if GoldStar is offering it, or have you heard anything like this? That if somebody were to go ahead and pull the trigger on a 7% interest mortgage today, with the term asking the lender if I wanted to refinance the
Yes,
same,
you can come back to us and we give you lender credits.
and that lender credits would be no closing cost, or
Well, you're
up
never
to
going to
50?
have no closing costs because
Because of
in
the
the state of Florida, you
Correct.
are a high cost closing state.
I want everybody to hear that. Yep.
You are always going to have recording. I cannot cover your recording. Sorry.
Well,
You're
that's good.
always going to have recording
Because
for the
everybody has been
mortgage.
talking about it and then put it out on the internet. I wanted people to hear it from
Yeah.
the first
Think about
source.
this. If a lender is saying no closing costs, then they're just going to raise your rate to cover the closing costs. In other states, like we are licensed in other states, we're licensed in Missouri, South Carolina, Pennsylvania, Connecticut, Tennessee, Indiana, Alabama, Arizona. Those states, a lot of them have, like Missouri, no title, no recording, zero.
Wow.
And their title insurance is half the price of ours. So in Florida, we don't have state income tax, right? Woohoo! That's why you move
I
here.
know, but we end up paying
But
it
we
in
get
different
you
ways.
every time you buy, sell, or refinance.
I know.
Because you have to pay to record the mortgage with the county and the state, and their promulgated rates based upon the loan amount. You also have to have title insurance, so that way when you close, you have a free and clear property able to be lended upon. So the title insurance will add up to, again, promulgated rate, $500 per every 100,000, $5 thereafter. So on even $100,000 mortgage, you're still going to have about $3,000 in closing costs because of recording and title insurance.
100%.
Doesn't matter. I tell everybody the same thing. Your $100,000 mortgage and your $400,000 mortgage are going to have all the same junk title fees, all the same lender fees. You're going to have recording and title insurance that will differ slightly because of loan amount, but they're still going to be there.
Correct.
So
So looking forward,
I'm ready to refinance everybody in the fall.
where do you
Then I'm
see
gonna retire.
where do you see the rates are going to be in the fall?
We think we are believing that in May we're going to see a little bit of cushioning, a little bit of softening, because a lot of major indexes come out again in May. Because remember, the numbers that you see are not based upon last month.
Correct.
They're based upon the last 12 months.
On the history, yeah.
So in May we see big inflation reports coming out. So we'll see. We fully expect things to be looking a little better. So we think May, the rates will soften. And then we think in the fall and spring, you're going to see them dip down.
And what do you think about the real estate inventory? You think the inventory is going to go up, or it's going to stay the
It's
same?
going up, but remember, it can go up all at once. We have more buyers.
Correct.
more
And we
people
want to
in the
close on
market
those buyers.
buying.
I want to meet more millennials.
Right.
I think I have
Yeah.
to start hanging
We
out in
have
downtown.
More buyers.
Yeah, definitely.
Between and the retirees that want to move here. We're in South Florida. If we were in Midwest, if we were in the Midwest, or maybe
It would be a little bit
it
more of a
might be a little
struggle.
bit different, right? Like
Yeah.
I do have a loan going in Missouri. It was very easy for that buyer to get under contract with 3% down on a condo.
Correct.
But here, everybody, it's still pretty aggressive.
Well, that's another
A little
struggle.
bit different, right? Like
Yeah.
I do have a loan going in Missouri. It was very easy for that buyer to get under contract with 3% down on a condo.
Correct.
But here, everybody, it's still pretty aggressive.
Well, that's another thing I wanted to talk to you right before we hang up. That the FHA loans, a lot of millennials that I talk to, they have this idea in their minds that with 3% they can buy into any types of properties. And according to my knowledge, after discussing it with you many times, is that especially if they're trying to get into a condo, it's reasonable cheaper than a single family home, especially in South Florida here. The condominium association and
Dictates what type of loan you're gonna
dictates
get.
what type of loan that you're going to get. And not a lot of the condos are FHA approved. However, right, there are some
Spot approvals. You can do spot approvals.
correct.
So to do that, it's basically the whole conventional process. For you to put 3% down, condo has to have reserves in their budget. It's a very calculated amount. You can't be more than 20% delinquent, which may change. You have to be 50. You can be up to 70% investor concentrated. You can't have a certain amount of commercial space. You can't have more than entity owning more than 20% of the units. Like there's all these different questions that you have to answer. Basically all those same questions for FHA, but they also look at your rules and regulations. So if you have a credit score requirement for the association, FHA is probably not going to approve it.
So another thing is that with the new state mandate that all associations are going to have full reserves,
It should help us.
You think it's going to help
It will
the
help
first-time
in
home buyers?
I think it'll help in 24 and 25.
Yeah.
That's why you need to buy now.
Yeah, you need to do it now.
Right. You can still get into condos for 3 and 5% down. I have a couple here on the Gulf, top of the mile.
Yeah.
Right. They're in the 200s. You can still get in there.
Did you hear that, guys?
Keep your mortgage payment, 2,000 and less. Like it's still possible. You can live on the Gulf with 5% down.
Well, let me ask you a personal question. And you're very knowledgeable when it comes to real estate, and you're very passionate about, mortgages, rates, and you always keep it on top of it. I know that you even, belong to a referral group that you guys meet each other, and that's what I love about you. You're a very consistent person, and everything comes out of your mind that you actually think about it twice.
May not be the best thing ever.
I mean, I think it is. It creates and puts a lot of value on you and how you present yourself. But is your job stressful? Like,
no.
you don't find your job stressful?
It's very stressful. You see me?
I know I see you. Like
stressful.
on an average day, you talk to many people.
Yeah.
And what do you like? If you were to say like, and I'm not saying that everybody's job is stressful. I think if your job is not stressful, you are not pushing the limits of what you can do.
Right.
And what are the points that's very stressful that you find that I'm sure it's not the client, but maybe the major institutions?
So I think part of my job, as far as me being with GoldStar and being a direct lender, that does alleviate some of my stress because I know my underwriters, I know my closers, I know my owner, I know my VP. I talk to them all the time. I'm constantly getting coached, taught. I can present scenarios to my underwriter to help us close the deals. So that part of stress, which other people may not have if they're mortgage brokers shopping their loan, they will have different stresses that I do. My stresses a lot right now are the condos. Like, can you just answer my questionnaire? Can you just provide the information that I'm asking for? If it's under litigation, can I just get a copy of the litigation?
I know that's been a big thing. A lot of the buildings with the litigations,
we can find GoldStar can finance those. We can finance litigation. I just
so
need
the difference
paperwork.
with GoldStar is actually lending their own money.
We lend our own money.
So
we are
you
a
guys,
direct lender. We sell direct to Fannie Mae.
So when you say direct lender, you have your own crew. You actually have your own underwriter.
Own underwriters.
Right? And then you have the loan officers, loan closers, everybody. So you have your team. You just want to make sure the person that you are bringing on the table meets all the qualifications.
Or I can help them meet all the qualifications.
Correct.
Right?
Correct.
You bring me somebody, maybe they're missing the score.
Correct.
But they have the income and the assets.
And then you can just have a conversation with your client saying that, hey, let's work on your credit score.
Yeah.
We can take these steps and then let's meet on the table again a month from now or 30 days from now. And
Oscar.
7 days.
7 days.
We
can rescore somebody in 3 days. I can rescore somebody in 24 hours if I need to.
It's one of the things, right? I mean, a lot of the people don't realize it. They just don't pay a cell phone bill or they have a dispute from a hospital. It just pops it in there. All you have to do is
And people don't realize now you can pay a medical collection and now it has to be deleted.
Correct.
I just popped somebody up 50 points from 2 medical collections.
50 points.
50 points.
And 50 points makes a huge difference on a mortgage.
All they had to do was pay $300 and show me proof. That's it.
I love that. And everybody is entitled of their free credit score and report once a year.
Yeah. But we have a thing now where we do soft pulls and I can simulate the soft pull.
What do you mean soft pull, like for people who doesn't understand that? So it doesn't really impact your credit.
Right. It doesn't impact your credit, but I get the scores. I see everything. I can simulate to see what we need to do. What collections are better to be paid.
But I believe the Congress passed something about those credit pulls that if a person is shopping for, especially you, if you were to shop for a person,
unlimited in 30 days.
You can have unlimited pulls in 30 days.
And then it's supposed to only go down 4 points. It doesn't go down 20 points for 2 pulls.
I know a lot of people are so scared.
I'm like, no,
people
that was
think
the
of
collection that popped in between. It wasn't the 2 mortgage pulls. Yeah.
Wow.
But we try to protect people, and do a soft pull now up front if they have a little bit of buying time, if they're not quite sure where their credit is, so we can help them get to where they need to be. Again, one of the advantages of working with a direct lender such as ourselves.
Well, you have full control of the situation. So, Well, listen, we covered a lot of the topics in
lot.
here, and
gotta get
we
Mr.
got to do this
We
again.
got to get Mr. Brad in here. He'll get everybody
Absolutely.
excited.
Everybody's going to be excited after seeing this. And I'm going to go ahead and upload it on social media. And it's going to be phenomenal, informative. And most importantly, people are going to meet you in person. You know, you're a great person. And a lot of the people that you speak most likely on the phone many times.
Yeah.
Now, this is going to open another perspective into meeting you. Is there anything that I didn't cover or I didn't ask you that you had it in your mind before sitting in here with me that you like to add?
I think the main thing that I would like to add, and what Brad says all the time, is sitting on the fence and waiting on the rates is only going to make that house go up higher.
Yeah.
And now it's only going to make the insurance go up higher. Citizens is changing a lot of things in the next 60 days. So I firmly believe now is the time. You know, I always say time kills deals. Well, now it really might. So if you're out there thinking about it, one other thing about GoldStar and the banks are going to get much more aggressive on these condos. They're not going to go back at these associations like, hey, did you realize you answered this question wrong, with a no or a yes on the structural? So case in point, condo on Bayview. They clicked a box that there was a building's integrity was affected. I happen to know the building because I live in the area and I go pick up my daughter at Gibbons. And it said, I happen to know that the seawall was affected. Well, the seawall is not attached to the building, is it?
No.
It's attached to the pool deck, right? So how does that affect the building structure?
Wow, that was a good catch.
That's an instance of utilizing your local lender, GoldStar Mortgage, Brad and Mary Ballard. That's an instance, like that plug, that's an instance of why using the local lender is so much more beneficial for these condos. The next is big banks require your content insurance to have wind and hazard. And now citizens, if you have a wind policy on your condo and you're in a flood zone, they're going to make you carry flood too.
Oh, wow.
We don't make you do that.
Did you hear that? That could be a savings of $1,500 or $2,000.
Your wind policy on a condo now is anywhere from $1,500 to $2,500.
Wow! Did you guys hear that?
It's the same
definitely a
insurance
great
as a house.
Yeah, that's definitely a huge
Game
savings,
changer.
game changer. Well, listen, I love it. Thank you so much again. We have to do this. I think we might even do this monthly, so you can give us a report of how the market is doing and how we are doing all over together. I thank you very much for being in here. And I want everybody to take the great points, which was from the great deal of Fort Lauderdale, Mary Ballard, Mortgage Mary. I thank you again, and you guys have a fantastic day. Take care, guys.
You can contact me at 954-684-8662, Mortgage Mary, and we are also the Ballard team over here on 33rd Street, 3322 Northeast 33rd.
And also, I will be adding that information into the description. If you guys like to meet her in person, send her an email, text, or however you guys like to contact Mary.
Here.
She's literally 24/7, and she doesn't have a bot. She will answer it personally herself. And I guarantee that. I remember when you were doing my mortgage, I was like, are we there yet? Are we there yet? Are we there yet? Well, thank you so much again. I'm looking forward to the feedback of this video.
Great.
Very good. Thank you, guys. Bye-bye.
Bye.